Hello, this video is recorded for those who missed the recent financial literacy workshop I offer in April 2025. So my name is Stanley Zhang. I'm a finance professor and also the Associate Dean for Programs in the College of Business of Stony Brook University. So in this video, we're going to cover some basic literacy for investing. A little bit about my research lab and the resources I offer for finance lifelong learning. So I am a director of the Blockchain Business Lab in the College of Business. In the university, we welcome faculty, students, and industry partners to work together to explore research and business applications of blockchain technology. I also offer a Stony Finance Lab, stonyfinlab.org website, where I share a lot of information and resources on research, events, and career opportunities related to behavior finance, investing, blockchain, startups, and academic finance research. You are welcome to check out the free website, where you can also subscribe to our YouTube channel and also subscribe to our weekly free newsletter, where students and myself share a lot of research resources, events, and opportunities in our field. So for instance, you can check out the page on personal and behavioral finance or the page on investing and trading, where we offer a lot of resources we use daily to advance our knowledge in investing and personal finance management, which are relevant to this talk. So let's go to Investing 101. What is the starting point? First of all, you need to set up your financial goals before you invest. So what are financial goals? So we're going to classify financial goals into three progressively higher level of goals. The first one is what we call financial peace. This is when you achieve debt-free, or you don't worry about repaying your debt, and you can maintain a minimal lifestyle. So for instance, you don't have credit card debt that you cannot afford repaying, and you don't worry about your student loans and other major credit debt, consumer debt. So you can sleep well when you achieve financial peace. The second layer is what we call the financial security. This is when you don't worry about maintaining your basic lifestyle, and you are able to achieve basic financial goals like supporting your basic lifestyle and also take care of your retirement, take care of the children's education, things like that. So this is second layer. The third, also the highest layer of financial goal, is what we call financial freedom or financial independence. When you reach this financial goal, you no longer worry about money and you no longer work for money. So we hope you can set up your financial goals, at least starting from the most basic layer, financial peace, and move upward to different layers in order to finally achieve financial freedom. After you set up your financial goals, then you can think about your investment plan in order to achieve those goals, right? So let's go through some of the definition of financial goals, as well as some of the common terms from personal finance lens, right? By thinking through personal finance lens, you will obtain a new perspective how to handle some of the common issues or challenges for individuals. So for instance, how do you define your financial goals, right? You can define from debts versus assets. You can define it based on net worth. You can also define it based on passive cash flows. So we're going to talk about that. And also, how are you going to define education, retirement, being rich versus being poor from financial length? If you have your financial goals and looking through those length, you're going to have a different perspective on those common terms. So for instance, So what is education from investing perspective? So you can consider education as an investment in your human capital so that you can earn higher dividend, which is your labor income in the near future. If you take an investing perspective for education, what you want to do is to make your education cost efficient and have reasonably good expected return. So how about retirement, right? Most people would say retirement is you no longer need to work. That's not how we define retirement from the lens of finance. In the world of finance, we can define retirement as financial freedom or financial independence. That is when you start to enjoy your work and life without worrying about money. It is the beginning of a new work life. It is not the end of work, right? We all know that Mr. Warren Buffett continued working when he's almost 100 years old, but does that mean he needs to work for money? No, he enjoy work. He's not working for money for more than half a century already. So let's take a look what is being rich versus being poor. From finance perspective, you can define being rich as someone who has earned more income than their expenditure. They have more assets than their debts. They have more passive income that can cover their non-discretionary spending, meaning their basic lifestyle. So wealth is what you don't see. When you see, that's consumption, that's not wealth, right? By the same token, someone is being poor, meaning that person doesn't have enough income to cover the expenditure, and that person has assets less than his debt, and the passive income is not sufficiently cover the non-discretionary spending. And depending on which perspective you want to take, is it when you are working on the first layer, second or third, you may use one of those definitions. Right. Okay, so hopefully we have sorted out some of the basic stuff. We have the financial goals. We know how to define a lot of major life decisions, status based on financial perspective. Now let's see how we can achieve them. To achieve different level of financial goals, you need different skills or different focus in personal finance. For instance, if you're working on achieving your financial peace, you want to spend more time handling your spending, budgeting, and management of debt. While you're working towards your financial security or financial freedom as your financial goals, this is when savings becomes important. How to invest and grow your money becomes important, and how to handle taxes and also build the downside protection of your wealth becomes very important. So I do recommend everybody to go on this personal finance survey that I work with my student and to take a look at some of the questions related to your financial literacy as well as blockchain literacy. So scan the QR code, answer the survey, and we will share the results of the survey in our website down the road. Thank you for your attention. So let's go to why we need to invest. Okay, we're gonna show you investing is the way to maintain and enhance your long-term purchasing power of your savings, right? So I'll give you an example. If you can buy a $5 Starbucks coffee today, how much does it cost you to buy the same coffee in 40 years? The answer is depends. Depends on the inflation rate. If we have an expected annual inflation rate of 1%, in 40 years, this coffee, the cup of coffee will cost you close to $7.50 in 40 years, which is not bad, right? However, if we have an inflation rate of 3% annually, and the same cup of coffee will cost you over $16 in 40 years. And if the annual inflation rate is 8%, which is huge, which is super high, and that cup of coffee will cost you over $100 in 40 years. Now you see that the same dollar cannot buy you same thing in the future because of the risk of inflation, right? And we know that inflation is there, and even Federal Reserve has a target inflation 2% of 2% or 2 to 3%. So consider many decades after your dollar, your savings won't buy you the same thing unless you consider investing. Take a even longer perspective. Let's look at the purchasing power of the dollar bill over the last 100 years, right? So in 1913, the Federal Reserve has indexed the $1's purchasing power to 1,000 units of consumption. So how much is that consumption power stay, right? Does that stay in today, right? So how much dollar today was the same as the dollar in 1930, right? You can see that that purchasing power of $8 bill has declined from 1,000 units in 1913 all the way to today. So what is that number? That number is 31.3 in March 2025, meaning that the purchasing power of a dollar bill has declined from 8,000 units of consumption to 31.3 units, which is equal to a decline of 96.87% of purchasing power. If you do the opposite calculation, meaning that in 1993, a millionaire at that time, who is the true millionaire, and how much money do we have to have today in order to afford the same purchasing power relative to a millionaire in 1930? It's close to $32 million, meaning that if you want to claim yourself to be a millionaire today, you really have to have around $32 million in order to be equivalent to a millionaire 100 years ago. That tells you that the risk of inflation is real, even for the strongest currency in the world over the last 100 years. There's still a huge decline in real purchasing power, right? So we're going to talk about what is investing, how we can invest. But you are welcome to go to the Financial Industry Regulation Authority, FINRA's, NFCS website, and they have a quiz question there about financial literacy and investor literacy. You can go there to find out your level of literacy. So let's talk about what is investing. So I'm going to summarize in one sentence. For individuals, investing is a suitable investment system to help you to achieve a specific financial goal given your risk of capacity and risk aversion. So I'm going to talk about a lot of keywords here, right? We talk about financial goal, and we're going to talk about what is risk capacity and risk aversion. Then we will go to the investment system, right? So investment is basically you give up your consumption today because you have excess consumption power, and you will put the money into assets that's going to bring you greater cash flow, greater consumption power in the future. It involves the trade-off in time, meaning that you are going to earn money because you sacrifice time preference. You get the time value money. Also, you will be paid for taking risk, right? Taking systematic risk. And that's what we call risk premium or beta in our field. Lastly, you could also earn extra wealth or consumption power through your efforts. This is what we call alpha in my field, by putting in your human capital, your research, in order to enhance your returns. Right. So for majority of people, probably you are going to earn money through the time trade-off and they're taking risk, but not so much through your efforts because you're not finance professional. You don't really do maybe you are not doing a lot of finance research to enhance your returns. And by saving your consumption value today, you have saving and putting into investment, you typically you have two broad areas to put to do investments. One is what we call the real investments, which involves, you start a real business, buying real assets, could include the land, building equipment, human capital, knowledge to produce goods and service directly. And that's what we call real investments. Alternatively, which is our focus, is you can also do financial investments. So financial investment meaning that you put your money into financial assets, which represent the claim for future cash flows generated by some real assets. So you don't produce goods and services directly, but instead you get a claim on the income generated by the goods and services produced by real assets, some like a company or a project. So financial investing is the storage of your purchasing power for future spending. If you are like the average individual investor, you engage in passive investing, and that could be a long-term positive sum game, meaning that over long term, your dollar can create more wealth in the future for everyone, right? For yourself as investor, for the company, for the employee, for the consumers, right? So in the long run, you can engage in passive investing, but still be able to generate wealth for yourself and for everybody. And in financial investing, we typically have two broad investment approach. One is called the top-down approach. The other is the bottom-up approach. And so for the top-down approach, and we typically have two broad steps. I'm going to focus on top-down approach here in this talk. The first step is asset allocation, which is to allocate your money across broad asset classes, which I'm going to talk about what are they. And the second step is under each asset class, you select the specific security or the fund. Could be mutual fund or ETFs and etc. And the second approach is what we call bottom-up approach. You don't really do asset allocation, but you select individual assets directly, which takes much more skill and care. So we're not going to focus on that, right? So if you engage in a top-down approach, you simply passively buy and hold your portfolio mix with periodical rebalancing. And sometimes you can do some macro optimization analysis to enhance your portfolio allocation. So now we want to talk about investor risk capacity, risk aversion, because this determines how you are going to determine your asset allocation. In one word, this is what we call risk profiling of investors, which is to identify as an investor your risk aversion and your risk capacity. So risk capacity here refers to the objective ability of yours to take on financial risk, which could be determined by your investment horizon, like in how many years would you need the money, and your liquidity needs, meaning that are you going to restore money from time to time, or you are not going to restore any money until decades later, your income, your wealth, your tax rate, and etc. We also need to understand your risk aversion, which is a psychological emotional responses that of yours to take on risk, right? So how much downside of like a drawdown risk you can handle psychologically without panic, without asking a financial advisor or yourself to sell your assets. That's sort of your risk aversion. Okay. So uh, risk capacity, we have talked about it, depends on a lot of factors. Could be 1 year, 3 to 5, 7 to 10, or longer term, 15 to 30 years, right? Depends on your retirement goal. And your risk aversion is an easy way is how much loss can you keep? Will keep you up at night. And so your actions sometimes reveal your true risk aversion. So understanding your financial goal, your risk capacity, and risk aversion, adding them together will give you a clear picture of your proper allocation in your portfolio. So now I'm gonna talk about what is the asset allocation. So this is how to invest. Right? So I'm going to talk about 4 principles for long-term successful investments, just to give you the broad idea of how you should invest, right? Including diversification, etc. So the 4 principles I'm going to talk about includes the following. I'm going to go over each of them with some examples and data, right? So the first principle is what we call, you need to understand the power of compounding, right? So understanding this power, this tremendous power of compounding will help you to commit to the long run. So, so let's look at an example, right? So how powerful is compounding? Let's look at if you can be a little bit earning a little bit more versus earning a little bit less every day for 1 year. Here a little bit is 1%. What the difference does that make? So it shows you the power of compounding, right? If you can compound your money by 1% per day for a whole year, your $1 will become close to $38. However, if you lose 1% every day for a whole year, your $1 will become 3 cents or less than 3 cents, right? So you can see that despite 1% is a tiny, tiny number, but with compounding for a long period of time, it transforms to drastic difference, right? So this is saying that if we can compound even with small amount returns, it can change the outcome drastically. This is why Albert Einstein says compound interest is eighth wonder of the world. So make sure you take advantage of the eighth wonder. Principle 2 is to be a disciplined investor, right? So what is discipline? So I'm going to talk about starting from being consistent in your savings and investing in the long run in order to take advantage of the power of compounding. So I'll give you an example. So if you start with $1,000, you invest only once versus you invest $100 each month, right? Let's look at the difference. If you start with investing $1,000 and that's it, with I think I was using 6% return compound for 30 years, your $1,000 will become $6,000, right? We assume monthly compounding. So 1,000 to 6,000, not bad. But if you start owning with $100, but you do that consistently every single month for 30 years, and with the same return, your action will transform into $100,000. Right? There's a big difference because you're doing small little things consistently through time, right? A second example would be if you start with at the age of 25, if you save $125 per month, which is like 22% of your 75,000 annual salary. But you increase your savings monthly by 0.5%, meaning that annual increasing is about 6%. If you invest your monthly savings in the stock portfolio that has the expected return 8% per year, which is good but not overly high assumption. And this is how much money you are going to have. You will save starting from 125 to $1,300 per month. And at the end, in 40 years, you will have over $1 million, right? So saving, the investing to get $1 million only takes $125 per month and increasing that 6% per year. Okay. So the second idea to be a disciplined investor is to save early. Of course, the earliest day you can save if you have not is to save now, right? You have to let the compounding work as soon as possible, as fast as possible. So you start from today. I often share with my students the story of Mr. Early and Mr. Late. So here, Mr. Early started to invest at the age of 20, $150 a month for 10 years every single month, right? Until he's 30, he no longer saves again. For Mr. Late, he started late, right? He started being age of 30. He also saved $150 a month, but he saved 30 years in a row until he's 60. So by age of 65, who has more money, right? And you can see that Mr. Early only saved for 10 years, Mr. Late saves for 30 years. But at the end, Mr. Early will have $1 million, but Mr. Late has less than $600,000. So even the 30 years of hard work is not going to beat the 10 years initial work, early work. So you can see the power of accounting really depends on the time you compound your money. So the earlier, the better. Okay? So how much should you save and invest for your retirement? So we do have some rule of thumb. So typically a financial advisor would advise you to save 15% to 20% of your income for retirement, right? So that's consistent with a lot of required savings rate of companies or organizations. Of course, depends on how aggressive you are as a saver. You can use the income based on after tax income or before tax income. If you're using before tax income, you are more aggressive saver. You're using after tax income, you're more like average saver. So what does that 15 to 20% number come from? So here we have a table where it shows if you want to replace your 50% of final salary in 20, 30, or 40 years, this is what we call the accumulation phase of your assets versus the retirement phase, right? In the retirement phase, are you going to put your money in a 40-60 asset allocation, meaning 40% stocks, 60% bond, which is very conservative, versus 60-40, 60% stock, 40% bonds, which is more typical. And also this is more aggressive, 80% stock, 20% bond. So let's focus on this typical version that if you anticipate you're gonna work for 30 years, then you anticipate you are gonna live after retirement for 30 or 40 years, and the number is really between 15 to 20%, right? With some typical return assumption. So this is justifying why 15 to 20% is gonna cover the average person's 50% salary if someone works for 30 years and expect to live 30 to 40 years after that. Okay, but of course the number can be drastically different across individuals because based on their years accumulation, their lifestyle, their expected return, and life expectancy. If you are worried, you just go for a more aggressive saving schedule. So the third point to be a disciplined investor is to maintain a well-diversified portfolio across different asset classes. So what are asset classes, right? We talk about for financial markets, the traditional financial markets has the money market instruments, which are the cash like instruments. Then we have bonds and stocks in the capital markets. So the allocation here for the long term is really typically focused on bonds and stocks, but you could add alternatives such as real estate, gold, commodity, crypto, and so on and so forth into the picture. If you want to take the top-down approach in the retirement account, depends on your risk aversion, risk profile, and you can select moderate or moderate regressive, aggressive allocation, which is basically depends on how much you put in stocks. Right? Stocks earn higher returns, but they are riskier than bonds in the long run. Right? So here you can look at the data that over the last 100 years, SP 500, which is the large cap stocks, on average offers close to 10% returns. Small stocks offers higher historically, but not so much in recent years. But if you want to put your money into cash, which is the 3 months treasury bill, and you just barely pair with the inflation rate, but treasury bonds, corporate bonds, even real estate gold in the long term, they can just outperform inflation slightly, but definitely not as much as the stocks. So that's why stocks are riskier than bonds, but they provide higher premium, higher returns than bonds in the long term. Right? So where do you start with your initial allocation in terms of stocks and bonds? If you have retirement accounts, you have to invest in certain mutual funds. But if you have IRA account, individual retirement accounts or Roth IRA, you could buy ETFs. ETFs are cheaper and also more efficient in tax treatment and transaction cost. And we would recommend to start with Vanguard ETFs and focus on the broad stock and the bond ETFs because they typically have very low expense ratio and they are more passive index ETFs. So now let's move to principle 3 as a disciplined investor, which is tax management and optimization. So the idea here is that you want to spread your money across different accounts with different tax treatment so that you can take advantage of tax exemption, tax deferral, and optimize across different taxable accounts, right? So broadly speaking, for retirement accounts, most of the accounts are tax deferred or tax exempted, right? So for instance, if you have individual retirement accounts, which refer to traditional IRA or Roth IRA, you don't need a sponsor of your employer, right? You can do it as long as you have earned income. If you invest your money into traditional IRA, it's before tax contribution and tax deferred growth, and when you withdraw money after retirement, you pay taxes at that time. In contrast, for Roth IRA, it's after-tax contribution, and it's a tax-free growth. When you withdraw money after retirement, it's tax-free, right? You don't pay taxes. You pay tax now. You don't pay it later. So when your tax bracket is low, your tax rate is low, you actually want to put money into Roth now by anticipating you're going to pay more taxes after retirement, right? So for starters, Roth IRA is really the best account to put your retirement dollars. Of course, if you have an employer, your employer may sponsor various other retirement plans, such as 401k for corporations and 403b for nonprofit organizations. If you're self-employed, you may open a SEP IRA or solo 401k, which have different contribution limits for small business owners, self-employed individuals. So you want to look into those plans. There's also some other plans. If your financial goal is to save for education of your children or for yourself, and you may consider 529 or ESA, right? So 529, both 529 ESA, when you withdraw money from the accounts for qualified educational expenses, is tax-free, right? So your gross is tax-free. But when you put money into those accounts, those are after-tax dollars. They have different contribution limits, the type of financial assets you can invest, and different income qualification. So you can look into them for more details. In addition, we also have tax advantage account for medical expenses, such as HSA, right? Health savings account. This is available to individuals with high deductible health plans, and they put it pre-tax dollars, and they can enjoy tax-free growth. When they withdraw money for qualified medical expenses, they don't pay taxes, right? Some people use this account to be a savings account, for the long term, and they enjoy tax-free growth, right? And we also have taxable account, which refers to the typical brokerage accounts, cash accounts, margin accounts that you invest using after-tax dollars, but you pay taxes on distribution, dividends, or capital gains, right? If you hold those assets for more than 12 months, you pay federal or state capital gains tax. If you have sold the assets within 12 months, you pay ordinary tax. Typically, your ordinary income tax bracket is higher than capital gains tax. So if possible, you want to hold your assets for more than 12 months. So now let's talk about principle 4, right? You want to create an investment system and manage your risk, right? So what does that mean, right? So the investment system is a holistic concept, right? We have talked about you want to start early to have an early financial planning and start safe today. You also want to create an actionable investing system while having your asset allocation. You also want to automate your savings and investing as much as possible. So every dollar you received as part of your paycheck goes automatically to your investment accounts, such as retirement accounts, automatically invested in your pre-selected asset mix, right? Stocks and bonds and others. You also want to make sure you have diversification everywhere and you rebalance your portfolio over time, right? Based on your risk aversion, right? So diversification means you diversify across asset classes. You use a multi-asset strategy as opposed to focus on one asset class. Also, you want to diversify across different accounts so that you diversify your tax liability, right? And keep in mind, passive investing typically are shown to outperform uninformed active investing. So people sometimes trade too much and they tend to engage in emotional trading. They end up selling low and buying high, which erodes their return. So if you cannot certain you're doing the right thing in trading back and forth and just to do a passive investing, that can serve you better. In addition, you want to stay mentally well, right, over the process of investing, because at the end of the day, your portfolio is gonna make you a happier, satisfied, and healthy person. You don't want to lose that end goal, right, in the middle of seeking a better or a bigger portfolio, right? Sometimes people are driven by emotion, they started to deviate their long-term investment plan, right? So what are the best ways to ensure that you stay with your plan? You are not changing it for bad reasons, right? So first of all, if you have stable, if not high income, it can help you to stay away from panic selling your portfolio at the market trough, right? If you don't need to withdraw liquidity, meaning money from your portfolio, because it's for retirement and you always have cash to buy assets on sale, you would not be panicked when market downturn comes. And you also don't over leverage, right? Because if you uh, over leverage, you're by borrowing money, engaging too big a position that you cannot afford. At the market downturn, you will be forced to liquidate and lose your principal. You don't want that happen to you. So a prudent and sustainable approach is not to over leverage. Right? You also don't want to engage in formal, right? What is formal? Fear of missing out, right? People, when they see their neighbors, friends are making a lot of money in certain financial investments, they tend to go after those approach. But are they in your plan? Do they help you to achieve your financial goals? Do they interrupt with your long-term investing plan? Right? If your answer is, yeah, those are not good for me, those are not in my plan, then don't do it. Right? Lastly, you want to have necessary insurance to protect your wealth, right? So insurances here could be your health insurance to protect your ability to work, to generate income. It could be your home insurance to protect your home, your car insurance to protect yourself as well as your liability or your property, and your term insurance and life insurance to protect your beloved loved one if something happens to you, right? So you want to have all kinds of layers of insurances in order to protect your money generating assets, including your house and your human capital, right? So to summarize, just keep in mind that real financial freedom comes when you have a large enough portfolio to generate passive income that supports your basic lifestyle. At the same time, you also have a satisfying career or hobby, right? Earns your income and makes a positive impact in the society, right? And so for investing 101, we showed you that you want to start investing by setting up your financial goals and plan, building a systematic approach to investing, stick to your plan through proper risk management, and persist in the long run so that eventually you can enjoy success and freedom. Right? The biggest dividend money can buy to you is the control of your life. Right? In order to gain that control back, and sacrifice initially, save and invest in the long term is going to serve you very well in the long term. I wish you best of luck and happy investing.